Today is your lucky day. I got a surprisingly simple strategy to finally see some profits in your account without taking huge risks. I'll split this strategy into 4 different stages, which are all price action related. First, you need to find the levels that get the most attention. When prices break past support or resistance levels on a chart, it's called a break of structure. And this matters a lot, being the first condition in our strategy. Break of structure means the price has moved significantly past the point where it used to stop before, going in the same direction as before. It's simple. In an uptrend, it's when the price goes higher than before. And in a downtrend, it's when the price goes lower than before. When the market keeps making higher highs and higher lows in an uptrend, you pick the latest high point. If the price keeps going up and closes above this point for a while, that's a break of structure. But when the market's making lower lows and lower highs in a downtrend, you pick the most recent low. If the price keeps dropping and closes below this low, that's another break of structure. The second condition is the development of a change of character. A change of character happens when the market starts to go in the opposite direction after breaking its previous highs or lows. It's like a sudden and big change in how the price moves in the market. For instance, we have this market that's been going down, making lower highs and lower lows. If suddenly the price breaks above its last major high point, that's a change of character. It suggests the market might be turning around, with buyers taking over. If the price keeps going up, making new highs and lows, we are now in a minor uptrend. Here, the price has been going up, making higher highs and higher lows. Look at the past breaks of structure going with the trend. But then, after one of these breaks of structure, the price turns around and makes a new lower low. This suggests the trend might be changing. After a small pullback, the price starts making lower lows and lower highs, showing a new downward trend might be starting. The previous bullish trend has now shifted into a bearish one. So to recap, first condition is a break of structure, which means the market structure keeps going in the same direction. The second condition is a change of character, which means price might be changing direction. After you find these 2 patterns, now I want you to take the Fibonacci tool and apply it from the highest point of the break of structure to the lowest point of the change of character. We're interested in pullbacks to the 50%, 61% Fibonacci area. That's the third condition. Price tends to go back about 50% of the distance after a big move, and even after smaller moves too. This happens a lot, and you can see it on any chart. So we'll keep an eye out for pullbacks to this 50%, 61.8% Fibonacci area, because they often show a high chance for the price to bounce back in the direction it was going before. The Fibonacci Golden Zone is a go-to gem for finding great trades. You'll often find that prices get zapped like magnets to this special area. Big money traders watch these levels too. It's common knowledge that major players like banks use these levels in their trading. And by lining up with the big dogs, you're ready to run with the pack. If they want to buy or sell at the same spot, it can push the price quite aggressively. Very important, you might not get an instant rejection right away when price reaches the zone. Prices need to chill and regroup sometimes. So consider this area as a memory zone. If prices bounced there before, they'll likely bounce again. It's a good area to take trades if you missed it the first time. Now, it's not enough for the price to just touch the zone. We need to see it reject off the level. The fourth condition is a wick rejecting the zone, a long thin line above or below the candle body. Wicks show fierce rejection of that level. When a wick spikes down, for example, but closes back up, it demonstrates the buyers have stepped in with force. Wicks reveal the price tested the waters at the zone before rapidly bouncing back, like dipping your toe in the pool before jumping out. A long wick into the zone, combined with the other factors, screams rejection. Of course, we need a backup plan, in case the price goes right through the golden zone. Set your stop loss just above or below the 78% Fibonacci level. We're looking at a chart that's been in a clear uptrend. This shows strong buying pressure pushing the price up overall. At this point, the price breaks above the previous high, confirming the uptrend is continuing with a break of structure. Soon after this, the price starts falling and makes a new lower low. This signals a change of character, suggesting the uptrend may be weakening. We take the Fibonacci tool from the break of structure high down to the change of character low. This shows us the pullback zone. We want price to pull back right into that Fibonacci area, which it did, printing a long wick before closing back down. This long wick into the zone shows rejection by sellers. We have a high probability sell setup with a stop above the 78% Fibonacci level and targeting double the amount we risked. We analyzed the crude oil market, which was in a clear downtrend on the 4-hour time frame, with lower highs and lower lows, showing strong selling pressure overall. After a bounce up, the price makes a new lower low, breaking market structure to confirm the sellers remain in control. However, on the next days, the price rockets up and breaks the previous lower high. This is a change of character, signaling potential weakness in the downtrend. We draw our Fibonacci from the lower low of the break of structure up to the high created on the change of character to find the pullback area. We now see that price pulls right back into that zone and prints a long wick up before closing back up. The wick into the Fibonacci area tells us buyers are rejecting that zone. I see it as a great opportunity for a long setup, with a stop right below the 78% Fibonacci level and targeting double the amount we risked. And look what happened. I don't know how to call it, bad luck or bad stop placement. The price reached the 78% level, broke slightly below it, stopped me from the trade, and you guessed it, went straight back up, right to my take profit area. Lesson learned, never put the stop loss so close to the 78% level. Leave the market some room for stop hunts, market noise, and others. This would have been a home run if I had my stop just a bit lower. In this chart, the market is in an uptrend, and you can see a pattern of higher highs and higher lows. This is the first sign that buyers are in control. Now, first condition, we're looking at a break of structure with this recent high that has been surpassed and the price has closed above it. Next, we're on the lookout for a change of character. After our break of structure, the price takes a breather and dips down, making a lower low. With our Fibonacci tool in hand, we draw from the highest point of our break of structure down to the lowest point of the change of character. We're interested in a pullback. We want the price to come back up to the Fibonacci golden zone. When we see this long wick into the zone, combined with our other conditions, it's our cue. We're seeing sellers stepping back in, and it's time to make our move. We enter a short trade, setting our stop loss just above the 78% Fibonacci level to be safe. Here, the market has been in a clear downtrend. We see lower lows and lower highs, signs that the sellers have the upper hand. As we apply our strategy, we first identify a break of structure to the downside. There's a recent low that's been broken, and the price has closed below it. After that, the price starts to climb, breaking past the last lower high. It's a change of character, and that's the second condition. The sellers might be losing their grip. We grab our trusty Fibonacci tool and measure from the break of structure low to the change of character high. We're now watching the Fibonacci golden zone. This is where we expect the price to retrace. And as predicted, the price declines, with a wick that pokes up into the zone. It's a clear sign that the buyers aren't done yet. They're pushing back, and we're ready to join them. We place our buy trade, setting a stop loss just below the 78% Fibonacci level to cover our backs, and we are aiming for a target that's twice the size of our risk. Regarding which time frame should you choose, remember that markets are fractal. A fractal is a pattern that repeats itself at different scales, like little mini versions of the bigger picture. Price movements form similar patterns, whether you're looking at a 1-minute chart or a weekly chart. The only difference is the time frame. No matter the time frame, the principles of support, resistance, trends, and breakouts apply in similar ways. We are looking for signs of strength, wait for a change in the tide, measure our bounce zone, and demand a clear rejection before making a move. This approach will keep you aligned with the market's momentum, whether you're joining the buyers or tagging along with the sellers. The key is knowing which time frame to trade based on your style and goals. I personally use it on higher time frames. This is where signals are more powerful and reliable. And remember, it's all about probabilities. You will encounter losing trades, but by following this strategy, you're stacking the odds in your favor. You're not guessing, you're using a methodical approach to pinpoint high probability trades. And I may sound like a broken record by now, but if you also monitor volume, you can filter the bad signals even more. These videos will explain how to add the volume component into your analysis.